Risk assessment techniques in trade finance involve identifying, evaluating, and mitigating the risks that arise during international trade transactions. Below is a breakdown of key techniques, strategies, and examples. 1. Identifying and evaluating risks in international trade. International trade is exposed to multiple risks due to differences in geography, regulatory environments, political stability, and financial systems. These risks include credit risk, the risk that a buyer will default on payment. Evaluation technique. Creditworthiness analysis through financial statements, credit reports, and buyer history. Country risk, risks associated with political instability, economic turmoil, and changes in government policies in the buyer's country. Evaluation technique. Use of country risk ratings from agencies like Moody's, Fitch, and Standard & Poor's. Currency risk, the risk of loss due to fluctuating exchange rates. Evaluation technique. Currency risk forecasting models and forward contracts to lock in exchange rates. Transport risk, damage or loss of goods during transportation. Evaluation technique. Assessment of the shipping process and carrier's reliability. Compliance and regulatory risk, the risk of non-compliance with international trade laws and regulations, which can result in penalties or confiscation of goods. Evaluation technique. Legal audits and reviews of trade documents and processes. Liquidity risk, the risk that a party might face difficulties in securing the necessary funds to complete the trade transaction. Evaluation technique. Assessing cash flow and liquidity positions of counterparties. 2. Risk mitigation strategies through insurance. To manage risks effectively, businesses can adopt the following strategies. Credit insurance protects exporters against the risk of non-payment by the buyer. Policies often cover political and commercial risks. Example, export credit agencies ECAs like Euler, Hermes, and Atradius provide credit insurance policies. Political risk insurance covers losses caused by political instability, government intervention, or expropriation. Example, the Multilateral Investment Guarantee Agency MIGA provides insurance against political risk in emerging markets. Cargo insurance protects goods against damage, loss, or theft during transport. Example, marine insurance policies cover ocean, air, or road transport risks. Currency hedging, instruments such as forwards, options, and swaps can be used to hedge against currency fluctuations. Example, a U.S. exporter might use a forward contract to lock in the exchange rate for a future payment from a European buyer. Letters of credit LCs. A bank guarantee on behalf of the buyer ensures that payment will be made if the terms of the contract are fulfilled. Example, standby letters of credit can serve as a secondary layer of protection in case of buyer default. Three. Case studies on effective risk assessment in trade finance. Case study 1. Exporter's use of credit insurance to enter a new market. An exporter of machinery to Brazil faced uncertainty due to Brazil's political and economic instability. To mitigate credit risk, the exporter purchased a credit insurance policy from an ECA. The insurance allowed the company to confidently enter the new market, knowing that they would be covered in case of non-payment. Case study 2. Hedging currency risk in trade with Japan. A European clothing manufacturer sold garments to a Japanese retailer. Due to exchange rate volatility between the euro and yen, the manufacturer used forward contracts to hedge against adverse currency movements. By locking in the exchange rate, the manufacturer avoided losses and stabilized their revenue stream. Case study 3. Use of letters of credit in African infrastructure projects. A construction firm was involved in a project to build infrastructure in Nigeria. Given the complexities of doing business in a developing country with fluctuating political and financial environments, The firm relied on standby LCs to ensure payment was guaranteed even in the case of unexpected events. The LC provided confidence to both parties and led to a successful project completion. Conclusion: risk assessment in trade finance requires a multifaceted approach. By identifying the various risks and employing mitigation strategies such as insurance, hedging, and letters of credit, businesses can protect themselves and facilitate smoother international trade. Regular monitoring and reassessment are also critical to adapting to changing risk environments.